please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The clock is ticking, the union budget is upon us. This is the last full-fledged budget before the general elections next year. It's also the first budget post the introduction of the revolutionary goods and services tax. Over the next 30 minutes, we speak with two major foreign investors to find out what they are expecting from the finance minister on February 1st and indeed from the Indian economy in 2018. Good evening and thanks for joining us on this special pre-budget series. I'm Latha Venkatesh. Among the big questions that bedevil foreign investors today are: one, will the finance minister impose a long-term capital gains tax on equities? And two, will this budget respect fiscal prudence? Well, I'm sure there are lots more questions. So let's go straight away to our first guest on the show, Lusy MacDonald, Chief Investment Officer of Global Equities at Allianz Global Investors. Lusy has, of course, been in this position since 2001 when she joined Allianz, and before that, she was at Baring. So that's nearly 2 decades of watching global equities, emerging market equities, and watching India. Lusy, it's a pleasure having you with us. Well, first up, do you guys really look at the budget very closely? Is it a serious policy document that can make or break your attitude to Indian equities?
Well, what we're really looking at is the impact that it will have on earnings, because at the end of the day, it is earnings, liquidity and valuation which drive the various markets that we're looking at. So the impact of taxation on earnings is something that is going to be of importance to us.
Okay, so you must have picked up a lot of straws in the wind before the budget. What would you want to hear, say, on fiscal prudence, say, on corporate taxes?
Well, we want to see some, clearly prudence is something that we will favour, but we also want to see any impact where taxes can be looser, and that will benefit the earnings of the underlying companies. So that's really what we're focusing on.
The announcement that there would be larger than expected government borrowing this year has already pushed up yields. Of course, yields were headed higher also because of higher oil prices, higher commodity prices. Would you worry if interest rates were increased by the Reserve Bank, probably because of the deficit or probably for other reasons?
Well, we're seeing everywhere a shift upwards in long-term interest rates now, and the short-term we're beginning to see rising in the US, we're beginning to see it rising in the UK, and so it is beginning to be a bit of a trend, and we're watching it very carefully. Now, the valuation of earnings of companies versus bonds has given quite a good buffer for the relative valuation. So that has meant that bond markets can underperform and in fact fall, but still equity markets have support because of that earnings support. Now, as we get towards some of the higher levels of yields, and that buffer begins to be quite narrow. But as we see it at the moment, there is still an equity risk premium which is supporting equities over bonds.
Okay. Well, which brings me straight away to your earnings expectation. What are you expecting in the current season itself? The third quarter numbers for several consumer companies, for Reliance Industries, have all been above expectation. What is your earnings expectation for FY18 and more importantly for FY19?
Well, it looks to us as if the mid-teens to 19–20% is possible this year, which if achieved, will support the current valuation on the market. And as I said, the earnings momentum does seem to be now better supported in India relative to the rest of the world than it has been for the last few years. So that is encouraging, and it would be good to see that catching up with the strong sort of top-line economic growth.
Well, that was going to be my next question. How are you looking at Indian valuations now? The Sensex and the Nifty have had about a 30% gain in 2017. The mid caps 40% and the small caps over 50%. Are valuations at discomfort zone at all?
Well, valuations are very much mid-range at the moment in India, and that is certainly on a price to book. Probably the best place to look at the moment because of some of those issues with earnings over the last year that I mentioned. So it is neither a strong buy nor a strong sell, and there is enough upside there in valuation terms if the earnings come through to provide a decent return in the market.
What are the sectors that incrementally look attractive to you, given both valuations and earnings expectation?
Well, it's the more cyclical areas of the market look as if they've got more upward potential in valuation, and that is still the case elsewhere. Interestingly, so in our global portfolios, what we've been doing over the last few months is taking some profits out of some of the high momentum areas like technology, which has done extremely well, and that is also the case in India and in Asia more generally. So that's what we've been doing, and then investing those proceeds in some of the more cyclical areas, in some of the energy related, and also in financials, which should benefit from those rising interest rates that we mentioned earlier.
Actually, let me put India in the context of emerging markets. Where is it in the pecking order for you?
It is rising because of earnings momentum, and the relative earnings momentum improving certainly means that it's more attractive. The valuations are mid-range, and therefore that's not a barrier. And I think it's offering sort of idiosyncratic growth, so domestically generated as well as externally, and that's always interesting in the terms of a global portfolio.
How do emerging markets stack up vis-a-vis developed markets for you, especially given that in the last few days we've seen US rates ticking up, 2.66 as I speak?
Well, the undervaluation of the emerging markets, which was clearer a year ago, is less the case now. So there's been some revaluation. However, the earnings momentum is still quite good, and there's decent yield which is available in the emerging markets too. So I think less attractive than a year ago in a relative sense, but still probably more attractive than average.
Okay, well, let me come to this growth issue. We had that piece from Mohammed El Arian asking if the global growth is now in a new paradigm, in a new normal, where growth may be much higher than it was in the last 10 years when it was in a new normal of slow growth. Would you say that equities have some more legs to run?
We think equities overall are still supported, but we do think we are towards the end of this very strong run, and valuations would suggest that, but also coming to the end of that big liquidity push, as I mentioned. So we still are positive, but we do think that the nominal returns are likely to be lower going forward than they've been in the last few years. Now, as far as growth is concerned, we think that growth is still likely to be held back in the mature world by the levels of debt. And the levels of debt have not come down, in fact they've gone up. And so that is a constraint on the growth rate that can be generated. Elsewhere, in emerging markets, the debt issue is not so widespread, outside China in particular. So it does look as if there is more potential for decent growth. So we are seeing decent growth, but it's not going to be at high levels, we think, in those areas which are still constrained by debt.
Lusy MacDonald, it was a pleasure listening to you. Thank you very much for joining us. back to our special pre-budget series, What the World Wants from India. And now we have Caesar Maasry of Goldman Sachs joining us. Caesar, thank you very much for joining us. Before I come to what you were expecting from India and the budget, first your view on emerging markets. Which emerging markets are growing faster than others? Where does India figure in your pecking order?
So we are actually quite positive the growth story globally, in emerging markets certainly, but India specifically. I think last year we had a couple of implementations, obviously, domestically in India, including the implementation of GST. You had the effects from the demonetization sort of earlier in the year of 2017. So I think having sort of passed those one-off slowdowns in growth, let's call them, we see a pretty smooth path for GDP growth to pick up in India to the mid-sevens for the calendar year of 2018. So we are quite positive there. I think another important aspect here when we think about emerging market corporates, which is very different from what we see in the U.S. specifically, is profit margins or operating leverage. That effectively across the emerging universe, you've seen profit margin declines over the last few years as growth slowed. And in the last sort of 12 to 18 months, with top-line growth picking up, we're now seeing an improvement in profit margins. That's already happened in some parts of technology in particular, but there are a few countries, and again, India is one of them, where profit margins had come down and only now are starting to recover. So in the macro landscape of strong growth in 2018, we see sort of outsized earnings growth, looking at about 18% earnings growth for Indian corporates in calendar year 2018.
Caesar, but then isn't much of that in the price. 2017 was a great year for equities generally, including emerging markets. Do you see any downside risk to this great bull run?
Yeah, well, I guess the way you phrase it, there certainly are upside risks and downside risks. I mean, I would be very quick to note, however, that the strong performance we saw last year in emerging markets was indeed fundamentally justified. And the way I would arrive at that conclusion is if you look at the performance, so MSCI EM was up about 34% last year. Only 5% of that came from an expansion in the multiple, which we would associate with sort of melt-up risk, this idea that it's speculative. The vast majority of the return came from a rise in earnings growth. About 22% came from earnings growth, and then about 5% from currency appreciation. So thus far, I think it's sort of not fair to characterize this rally as a speculative bubble or a melt-up or so on. It's really been fundamentally justified. And looking forward, as we sort of discussed, we do think that growth sort of pillar stays in place. But clearly the risk is going to be one of global nature. And that effectively is, what is the big event happening globally this year? Well, it's the removal of monetary support, unconventional monetary support, whether we see the Fed raising rates, reducing the size of the balance sheet, the ECB presumably tapering the purchases in Europe. This could have liquidity effects. I think this is clearly a risk to global financial markets, but I think the key point here is that is actually also very much a DM risk. This is not a specific emerging market risk.
Caesar, are you putting any fresh money to work in India, and would you have any sectoral preferences?
Yes. So to be clear, India is absolutely an overweight market. I do think heading into 2018, the dynamics will shift slightly compared to last year. What I mean by that is last year was a great year for fixed income, obviously, in the Indian market, and you saw a huge amount of inflows, I think somewhere in the order of about 20 billion coming into the fixed income market. In part, that was buoyed by, obviously, very low inflation, also caused by low food prices. I think some of that starts to fade as we look into next year. So clearly, I think 2018 will be more equity-centric. To be clear, we have a price target on the Nifty of 11,600. So I think obviously things have moved a lot, but we're still about 6% or 8% shy of that target. So we still do see upside. In terms of the sectoral composition, again, I think this is a thematic issue across emerging markets more generally, but we would tend to rotate into some of the domestic growth-oriented names. Now, in India, you have a few of the industrial companies, some consumer companies that we'd like on that theme, but I think also some of the banks. And obviously, the recap program of last year should help that domestic flavor as well.
Okay. Well, you all have been speaking about a Nifty target of 11,600. That's your upside target. Do you have a downside target as well? or a downside likelihood?
Well, we don't have downside targets because we do think things will be moving higher. But I do think if you look sort of historically, it's very regular that EM equities have a 10% correction during some time of the year. In fact, 2017 was basically the first year since I think the mid-1990s where we didn't see a 10% contraction at some point during the year, and then obviously subsequently you can recover from that. But so if you're generally concerned about market pullback risk, I would say 10% is usually the right amount of magnitude.
Okay, you spoke about banks earlier and the positives because of recapitalization. Are you buying the public sector banks, or would you prefer to stick with private sector banks?
So I think financials in general we actually like across emerging markets as a leverage to domestic growth. I do recognize that NPLs have picked up in a number of economies, and not just in India. But I would say at this point in the cycle, when growth is really improving, we're sort of less concerned about those NPL concerns. It's really when credit growth is starting to slow, you start to face some sort of recessionary risks, that the NPLs become a much bigger issue. So we don't really have a preference between private or public from my strategy team, but as a sector as a whole, I think, again, that's a way to leverage the domestic growth cycle, which is really where you want to be. And then the last point I'd make on that is, if we do go back to your question on melt-up risk and bubbles, when we do look across valuations, the one part that starts to look sort of frothy, if you will, is the technology space. And that's a little bit of a global concern, and that's also why I think at the margin you want to rotate from those areas into the more domestic-orientated sectors.
Okay, well, I would assume the Indian IT stocks are not in that terrain yet, probably more US stocks. But, let me come to the liquidity issue. Global liquidity is so strong that both DMs and EMs are doing well. Do you see EMs outperform developed markets in 2018?
Yes, so that is certainly a key pillar of our view. We do think that emerging market assets will outperform. Again, I think that's true in credit, but certainly also in equity. And I mean, basically the way I think about that is whatever you're getting in developed markets, you're getting at a better price in emerging. I think there's a better growth profile. There's, as I mentioned earlier, more upside in the margin, in the operating leverage component of the equity story, but also valuations. I'm not going to tell your viewers that equities are inexpensive when you look at them any sort of multiple basis relative to history. But when you compare them to developed market valuations, I think EM is still trading at a clear discount. And this really matters for your global investor who's allocating capital across the equity landscape. I think the valuations are much more compelling in emerging markets.
Okay, and the most important question, we have the big union budget next week. As an investor here, what is your biggest expectation from the budget?
In general, we obviously look for the distribution of sort of capital expenditures, expenditures more for growth as opposed to subsidies. That tends to be things that are more market friendly. But again, I would really kind of point your viewers to look globally on this issue. Fiscal dynamics in EM are basically one of the areas that have not improved so much. Growth has improved, inflation has improved, meaning it's come down in most of the economies. Current account balances, trade balances have improved dramatically. India is certainly an example of that. But the fiscal balances are, I want to say, sort of secondary in nature at the moment. Fiscal dynamics become a big issue when you come into a growth slowdown, and then we worry about how much room the government might have to act counter-cyclically. But in the current environment of a very strong global growth tailwind, I don't think the fiscal dynamics are actually the most important issue facing the market.
Okay. Well, actually, that's good to hear because that's taking away all the attention on the budget. Good to hear from you that in a growth year, that wouldn't be so much of a concern. Thank you very much, Cesar Maasry, for joining us on this special broadcast in the run-up to the budget, What the World Wants from India. Thank you very much for watching.